As Democrats and Republicans debate raising the debt ceiling, China has called for the U.S. to take responsible measures and handle the debt situation in order to boost confidence in the dollar. China holds $3.2 trillion in foreign exchange reserves, about two-thirds of China's reserves. Beijing is the biggest creditor of the United States with more than $1 trillion in reserves. A default on loan payments may reduce the value of those holdings. For decades, the U.S. has been buying much of China's export goods, making the two countries inseparable. Pietro Rivoli is a professor of international business with specialization in Chinese finance at Georgetown University. She explains the relationship.
The Chinese are our biggest lender. They hold upwards of $1 trillion of U.S. Treasury securities. They're also our lender in other ways as well, because they don't just hold the debt of the U.S. Treasury. They hold the debt of, say, mortgage debt. They hold corporate debt. They hold all kinds of debt. So they're our biggest lender, and that relationship has been growing over a number of years now because China has traditionally had a large trade surplus with the United States. So we have a very symbiotic and very inextricably linked economic relationship where Chinese lending finances our consumption from China.
Professor Rivoli further explained the potential decrease in value on China's holdings if the U.S. does not raise the debt ceiling.
They are an investor just like any investor, just like you or I. And what they are concerned is with the value of their assets declining. So, you hold a stock in your portfolio or your mutual fund, you're worried about the value going down. The same thing is true with the Chinese lenders. They are worried about the value of these securities deteriorating, and that will happen certainly if there is some sort of downgrade by the rating agencies. It will also happen if there's increasing pessimism or concerns about the ability to reach a deal. So there are any number of kind of bad news scenarios that can cause the value of those securities to fall.
Chinese financial experts see a huge impact on their economy, a scenario they are not happy about. Zhang Ming, an expert at the Chinese Academy of Social Sciences, a Beijing research group, argues a default or downgrade would be significant for China.
Yes, I think as a Chinese, we worry about that scenario. If the limit cannot be lifted, so that means the U.S. government bonds may be technically defaulted. So the market value of the existing U.S. government bonds will decline dramatically. So Chinese government will suffer a capital loss.
However, some American economists think that the issue is exaggerated, saying it's nothing more than politics. Joseph Foudy, a professor at NYU's Stern School of Business, where he focuses on Asia. Professor Foudy said the effect on China would likely be a little more than just politically embarrassment.
For China, the challenge that it has is it's growing its dollar holdings every day, and it has to worry that as the Chinese currency appreciates, those holdings, on paper at least, will seem less valuable. But they have to worry that the domestic political fallout, that on paper they might take a loss from this investment. Similarly, they're always concerned that the current fight in Washington over the debt ceiling could lead to a downgrade of the U.S. Bonds, which would mean interest rates go up. Since their bonds are issued at a lower interest rate, the price of them would go down. And again, they would technically recognize a paper loss. How significant that is not really clear, but politically it might be embarrassing for the government.
However, Zhang Ming disagrees.
Well, I think I have a rather different opinion. I think, yes, in the short term, the risk of the U.S. government bonds maybe cannot be exaggerated. But what I really worry about is our safety of the foreign exchange reserve assets in the mid-term. So I think in the mid-term, maybe the United States will have inflation, and the U.S. dollar will depreciate against other major currencies significantly. So that means, as a major holder of the U.S. government bond, we will suffer dramatic news from either the domestic inflation in the United States or the depreciation of the U.S. dollar against other currencies. So actually, we did not worry about the near term, but we must worry about the mid term.
Zhang also pointed out that the effect on global economy cannot be understated, especially as it concerns China's export market.
The default of the U.S. government bonds may cause another turbulence of global financial market, also lead to very more slowly recovery of global economy. That will also hurt the Chinese export. Then it will put another negative impact to Chinese economic growth.
If the U.S. does default or is downgraded, Zhang Ming said that they would be forced to move into other markets, investing in emerging economies should the situation become more dire.
If the U.S. government begins to default the U.S. government, then Chinese government will lose its confidence, safety of the U.S. government bonds. Then, in the new incremental foreign exchange reserve accumulation, I think Chinese government will begin to decrease the purchase of the U.S. government bonds and begin to buy more other currency denominated assets, such as the euro denominated assets, the Japanese yen denominated assets, or even some new emerging economies financial assets.
However, Professor Rivoli said their options are limited, calling the threats verbal bluster.
They are the ones holding these assets. So, what kind of options are there for flexing muscle? They're somewhat limited. They can try to sell these securities, but in a falling market, that's not a good idea. So I think that you're kind of limited to the discussions that you've heard over the past few years, beginning with the financial crisis, and that is a lot of verbal bluster. There are very few options, tactical options, that they hold.
As for who is to blame for the codependent relationship, both sides point to each other. Professor Foudy charged that the debt holdings are simply a side effect of China manipulating their currency to create an export-led market.
I mean, the real issue for China is that it has a model where it exports more than it imports. And as long as that's the case, it's going to end up with foreign currencies, particularly the dollar. And it has to do something with those. Unless it wants to buy American goods, it is stuck buying American assets. And that's part and parcel of its export-led growth strategy.
Meanwhile, Zhang says the U.S. has been far too freewheeling.
Two countries should both assume their responsibilities. For China, we should further increase the flexibility of the RMB exchange rate regime. We should let RMB to appreciate against US dollars furthermore. But for the United States, their households consume too much, so their saving rate is very low. This is also a direct reason for the U.S. current account deficit. So for the U.S. government, they should urge their consumers to save more. So both China and the United States should do their own contributions to rebalance the global economy.
Beyond the finger-pointing, the links between China and the U.S. mean that both countries have a responsibility in maintaining a balance within their social and political systems and must settle differences in order to keep close ties. Experts from both China and the U.S. understand the interdependence between the countries, and despite the difficulties both of these countries are currently facing, they are more than ever tied to one another, for better or worse. For Voice of Russia, I'm Elly Mui.